Before we get into the expenses, which you can use to reduce your tax, I want to touch on a few areas because a few of you will have these investments. If you have a fixed deposit or a large or any savings balance, you will earn interest income. If your salary lands in a rupee, let's say you transfer some money for expenses, you have 1 rupee in your bank account, that sits overnight, it will earn interest. Of that interest, 10% is taken by the bank each month and paid to the Inland Revenue. So that's interest income. It is liable to 10% withholding. However, you have to add that, like I showed you in the 1, 2, 3 section, you have to add that to all the other income you earn and calculate your total tax. Right? Okay. If you receive a dividend, you have to pay no additional tax. But remember, before you receive the dividend, 15% has already been taken off and paid to the government with your ID card number. If you have rental income, your tenant is supposed to deduct 10% of the income that they pay you and pay to the Inland Revenue. This is one of the big revenue leakages of the government. They don't collect this. And if you're paying, let's say you get a side gig, right? And you're earning some rupees there. If you receive more than 100,000 rupees a month for that, the person who pays you is supposed to deduct 5% and pay the Inland Revenue Department that 5 in advance with your ID number. Right. Now, if you can see, there was a theme here. Everything that you earn, somebody's supposed to keep a part of it and pay the government before you get the opportunity. But if you buy treasury bills, bonds straight from the government, there's no withholding tax. You have to declare and disclose the holdings and pay the tax. Right. So unit trusts, a lot of you would have money with Linear Wealth or NDB Wealth or First Capital's money market fund, mutual funds. They're all essentially unit trusts. Okay. And remember at the beginning of this program, I said, all individuals, as people, we are taxed on cash basis. So if you put money into a unit trust and you don't pull it out, then you won't be taxed because you haven't taken anything out. You haven't realized the gain. It is accruing. Okay. So you got to realize this. Let's say you earn 100 of anything, right? And that 100, if you take it out, you pay tax on it, right? At whatever the prevailing rate is. If you don't take it out and allow it to accrue into the next year, right? So if you take it out and put it back in like a fixed deposit, that's bad, right? Because you've realized it. Even if you tell the bank, I don't want it, you renew it, effectively you've broken the FD, right? So the money comes out, you have to pay tax on it, even though you didn't actually use any of it and you reinvested all of it. Whereas unit trusts, that money keeps growing until you actually draw it.